Good afternoon and welcome. My colleagues at the Federal Reserve and I are dedicated to serving the American people. We do this by steadfastly pursuing the goals that Congress has given us: maximum employment and stable prices. We're committed to making the best decisions we can based on facts and objective analysis. I'm not asking Congress to do anything right now. I sometimes have noted that it would be appropriate. I put it this way. We do what we do, which is we're assigned a job, which is maximum employment and stable prices. We do financial stability, we do bank regulation. The U.S. economy faces significant longer-term challenges around potential growth, around labor force participation, around disparities of income and wealth, around all kinds of things. And those are issues for Congress. They're not issues for us. But if you really want the U.S. economy to be all it can be and raise the potential growth rate of the United States, you need proper monetary policy. But really, it isn't monetary policy. Really, it's fiscal policy that supports, inclusive growth. I am going to maintain my longtime practice of not commenting on anything any elected official would say. But we believe that monetary policy is in a good place. Policy is not on a preset course. Let me end with a few words about our technical monetary policy operations. We see the current stance of monetary policy as likely to remain appropriate, as long as incoming information about the economy remains broadly consistent with our outlook of moderate economic growth, a strong labor market, and inflation near our symmetric 2% objective. We believe monetary policy is in a good place to achieve these outcomes. Inflation continues to run below our symmetric 2% objective. Over the 12 months through August, total PCE inflation was 1.4%, and core inflation was 1.8%. Inflation pressures remain muted, and indicators of longer-term inflation expectations are at the lower end of their historic ranges. We're mindful that continued below-target inflation could lead to an unwelcome downward slide in long-term inflation expectations. However, against the backdrop of a strong economy and supportive monetary policy, we expect inflation will rise to 2%. Inflation moved down in the first quarter of this year. We thought that was due to some extent to idiosyncratic or transient factors. That turns out to have been the case, so it's moved back up. But it seems to be settling in below 2%. So we really don't see that risk. Inflation expectations have also kind of moved down and sideways, both surveys and market-based over the course of this, of really the recent months. And, we think that inflation expectations are very important in driving actual inflation, and we're strongly committed to achieving our 2% inflation objective on a symmetric basis. We think it's essential that we do that. I think monetary policy works through the channels that we understand. I think the effects are clear in what we think of as the interest rate sensitive sectors, which are some of the ones that I mentioned. I think interest rates are a factor in business investment, but I don't believe they're the main factor, a main driver. And I think what one would like to see to support greater manufacturing activity, business investment, and exports would be a global recovery. And there's a lot of monetary policy accommodation and some fiscal accommodation, maybe, in the global economy now. Not here, but perhaps elsewhere. And that should support growth in the global economy. The slowing global economy, you have a synchronized slowdown in economic activity around the globe. It's been building for just about 18 months now, and that's having an effect on U.S. activity. That's part of the weakness in manufacturing, export, and business investment. We've had trade policy uncertainty, which we think also has been weighing on activity and investment and sentiment. And we've had inflation, which we've called out the risk of inflation running persistently below 2% as a risk that we needed to address. So we've been doing it to address all of those things. One of the surprises, as I mentioned, was that banks that had told us that their lowest comfortable level of reserves was here, they were well above that, and yet they didn't deploy that liquidity when there seemed to be great opportunities to do that. That didn't happen. So why is that? And so we're doing careful analysis of that. You ask, would we lower capital or liquidity requirements because of this? I don't think so. I don't think that's where this goes. I think where it may go, though, is to look at, for example, intraday liquidity, which used to be a common thing. It used to be a common thing for banks to have intraday liquidity from the Fed, what are called daylight overdrafts. That's something we can look at. Also, there are just a few technical things that we can look at that would perhaps make the liquidity that we have, which we think is ample in the financial system, move more freely and be more liquid, if you will. And those are things we would do, but only if we can do it without compromising safety or soundness or financial stability. We surveyed the banks carefully about what was their lowest comfortable level of reserves. And many banks that were well above that level did not take that excess cash and invest it in the repo market at much higher rates. They didn't do that. And so the question is why?